Welcome to our part two of Healthcare Week live chat. I'm Dennis Stearns. We'll be joined today by SFG's Co-Chief Investment Officer, Global Strategist, PJ Williams. And today we're going to talk about what is healthcare doing today and in the future from an investing viewpoint. So we've had a number of interesting guests in recent weeks on the COVID-19 impact. We have a great program this afternoon at 4, directly on point to that. This is going to be about what are companies and their investment strategies looking at today and in the future. So with that, we will jump right in. So this came out recently from Deloitte talking about 5 key elements of smart health communities. And it's interesting that all 5 of these themes have been hit and discussed by our special guests in healthcare, who have included healthcare leaders, one who's the chairman of the board and major leader in a couple of national companies, several young upstarts, entrepreneurs in the healthcare space. And so they basically reinforce this empower proactive health and well-being management as being one of the huge trends. Now, this was a trend before COVID-19. And the future was always one where they hoped in the healthcare industry they would move towards more wellness and prevention of illnesses in advance, or mitigating the risks of illness, catching things early. Certainly many levels of cancer and other things, catching them early is a good thing with today's technology. They believe this will be accelerated. Foster a sense of community and well-being. That again is something that goes beyond the existing healthcare system, although many of the healthcare leaders we work with are working with leaders in their local communities to do exactly that, to create a system within the community. Enabled by digital technology and behavioral science. Well, that has accelerated at an amazing rate. And again, through our telemedicine, telehealth, special live chat, we had that wonderful speaker, CEO of a company on Tuesday this week, talking about behavioral science. This whole area is exploding at a very, very fast rate. Meaningfully use data to improve outcomes. Well, that's a very important piece of a smart health community, and one being accelerated by COVID-19. And we heard from the person that helped Apple develop their data system earlier this week. He shared with us some of the things that may be coming in data, and that's a tip of the iceberg. And then finally, enable new innovative ecosystems. We're going to talk about that more in just a second, but there clearly is a lot of work going on there. So before COVID hit, February of 2020, for those of us who can remember back to then, McKinsey & Company released their 7 healthcare industry trends to watch. And these are trends that SFG has been following for some time, hearing about in our research, publishing in some of our research newsletters. But COVID-19 clearly has accelerated, in our mind, at least 4 of these 7 industry trends, and 3 are probable accelerations. The first one is the business model transformation. And by the way, these quotes are all directly from McKinsey, and in the written chat on healthcare this week, we have extra texture around each of these 7 key trends in healthcare. So business model transformation, no question that that is happening at a fairly high level. Again, telehealth, telemedicine is a huge player there. Number 2, healthcare ecosystems. Regulatory pressures have from time to time stopped or delayed the development of certain drugs or technology. Now, you could argue if this goes too far the other direction, that things are too loose, that will create other problems. Well, welcome to the fifth phase of the techno-industrial revolution. In the former four phases, from the original invention of railroads to the Industrial Revolution itself to the cotton gin, every single situation we've had in the past has created these same problems. It's just that we're going to be living with them and hearing about them at levels that previous generations never heard about. So one of our healthcare leaders described it as, I guess he reads a lot of Dickens, the best of times and the worst of times. Number three is healthcare reform. This is one that is pretty interesting from the standpoint of how it's being impacted by COVID-19. And this is the one that possibly will be most impacted by the November 2020 elections. Next slide, please. So programmatic M&A, which stands for mergers and acquisitions, and an agile operating model. Remember, McKinsey is writing this from the viewpoint of healthcare systems. And so senior leaders having to rethink talent, organization structures, operating model. Well, all that is being done. It is really hard to fly an airplane through a hurricane while also upgrading the airplane for what comes after the hurricane. So this is one of probable acceleration. I think time will tell exactly how much this accelerates. Recession and resilience, this is one that many of the healthcare leaders we talk to, many of the articles and other things we read say that many of the healthcare systems were working on these things pre-COVID and wish that they had been accelerated faster, but they are accelerating faster now that we're in the middle of the pandemic. Next slide. Social influencers of health. Well, if you tuned into our live chat earlier this week and to the telemedicine live chat, you heard some of these factors. And there's no question that C-19 has been affecting some parts of our populace more than others, and particularly the working poor and many of the lower income working class affected in more dramatic ways. None of this is new. There's plenty of very well peer-reviewed research studies around all of this. But as some of our expert commentators said earlier this week, this is an area that bodes well for the technology accelerators that are going to be used more and more in future healthcare. And finally, drug spending. I draw your attention particularly to the very last sentence. Stakeholders can remain alert for innovations and leaps in best practices that have the potential for greater impact and improvement. Well, welcome to the pandemic. There are so many innovations and leaps in best practices. I mean, it's not even counted in the thousands. It's counted in the tens or hundreds of thousands for healthcare all around the world. And this is one of those interesting areas. We were reminded by one of our clients, who's a healthcare leader earlier this week, that many crisis and stressful situations in our history have created great leaps forward in a variety of things, including healthcare. And he happens to be a student of history, and particularly how medical advances happened in wars. And he reminded me about the Civil War, which, again, you think back, well, wait a minute, that's a long time ago. How could there be advances there? Well, he reminded me of 7 items that advanced in the Civil War or were invented: ambulances, the anesthesia inhaler, plastic surgery, sanitation, prosthetics, embalming, and pavilion hospitals. So again, it's hard to say that any one of these trends is a greater influence on us in the future than another, but there's no question that there's some big things afoot. It's also something that we're going to tackle more in the written healthcare chat about who will be the beneficiary of some of this. Well, our folks who work in the healthcare industry, up and down all kinds of different roles and responsibilities, they're not so sure it's them. For some, we've heard quotes like, best of times and worst of times. We've heard quotes like, well, this may be my time to retire. We heard a young radiologist who basically said, I'm already figuring out my pivot at age 40 or 45 because chances are I'll just have to do something entirely different. It may be within radiology, but an entirely different element of it. So healthcare professionals, these things may or may not be the holy grail. Consumers, it's generally thought, are the ones who will be the big beneficiaries over the next 10 years of a lot of these trends. Next slide. So we've talked before about VUCA in general, the sailing in uncertain times, uncharted waters. So VUCA stands for volatility, uncertainty, complexity, and ambiguity. Well, healthcare has it in large doses today. And again, tremendous challenges for healthcare leaders and professionals, potential gains for consumers. So beyond that, think of it from an investment viewpoint, and that VUCA makes the zone of uncertainty over some of the healthcare stocks. Now we do a lot of things in different levels that are beyond stocks as well, but just in old traditional healthcare stocks, that zone of uncertainty has increased. Next slide. So the question that we are asking is healthcare a fat pitch? Reminder to everyone, fat pitch is that Warren Buffett term. It's actually a baseball term for a slow pitch over the plate that's easy to hit. They don't come along very often. They generally are where trends are accelerating and valuations are reasonable. If you eliminate the and, if you say, oh, trends are accelerating, it must be a fat pitch. No, that's not the case. And so, again, some of the positives on healthcare, aging population, that hasn't changed in the pandemic. Growing demand for healthcare around the world, that hasn't changed. Good balance sheets in healthcare companies in general, that hasn't changed, although some healthcare systems are under more pressure than they were before. Technology accelerators, that's changed big time and accelerating. The tailwind, the lower chance of additional regulatory hurdles, no question that there are certain areas that regulatory hurdles may be lower in the future. And then you heard in our live chat around telehealth, telemedicine. Telemedicine is now a billable service, and that has helped accelerate that as well. Now, on the negative side, all kinds of things that we're looking at, pricing pressure on premium income billable services. There's more pressure on Medicare and Medicaid as budget deficits grow. That's going to be a huge theme for the future that there's not been a lot written about. There's been a lot written about the impact on the budget deficit, but not as much coinciding with healthcare, because healthcare is a major increased element of future budget deficits as the population ages. Number three, giddy investors have bid some companies to premium prices. PJ will get into some of that. The expectation that COVID-19 developed drugs are going to be heavily discounted. So whoever comes up, whether it's one of the young upstarts or one of the established companies that come up with great drugs, great vaccines, whatever they are in the future, it's not entirely clear that's going to be a boon for them from a profitability viewpoint. And then finally, telemedicine is selling at a very high premium. And, we were back in the biotech industry in the 1990s. We remember all the hype around biotechnology. And some of those companies came out and were fabulous companies. Amgen, Genentech, Biogen, great companies for the future. But in that time frame of the 90s, they were bid way too high relative to their future prospects. So with that, I'm going to turn it over to PJ and to just get into, which segments of healthcare and then some individual company discussions.
Thanks, Dennis. And I do want to preface the next few slides with a disclaimer that Stearns is not recommending buying or selling the individual companies we're going to touch on. The data you see for fair value is coming from, that's Morningstar's opinion, so just one independent party. And also, we're going to be talking at a high level about what these companies are doing well and where their opportunities might be and what also what might be headwinds for some of these companies. We're not going to be talking about operating margins or balance sheet leverage. So with that, healthcare has a bunch of subsectors. When you say healthcare, what are you talking about? Many people think of healthcare, maybe they think insurance companies, United Health. They might think drug maker. Obviously, Moderna has been in the news lately with the vaccine hope. So we'll touch on a few different sectors. The main subsectors are listed here: big pharma, tech and med device, services, including HMOs and hospitals, biotech, and now telemedicine. Obviously, with what's going on with COVID-19, has obviously become almost a sector upon itself. It's really in that kind of digital health world. There's lots of ways, not just direct telemedicine, but lots of ways companies are innovating and developing new niches within healthcare. So we're going to touch on three of the largest healthcare sector ETFs and just kind of look at what are the companies that they each hold. And so this is the Healthcare Spider ETF with the ticker symbol XLV. And most people would recognize the companies on this page. When you look at going down the list, you got Johnson & Johnson, Pfizer. Over on the right, we have Medtronic. So companies that your typical consumer has probably heard of, either through a consumer product or through maybe a drug that they're taking. And so on the next slide, what we'll talk about is Johnson & Johnson specifically. So Johnson & Johnson stands alone as a leader across the major healthcare industries. The company maintains a diverse revenue base, developing research pipeline, and exceptional cash flow generation that together create a wide economic moat. And I think we all know that Johnson & Johnson has many verticals. And thinking about med device, everybody's heard of their consumer products and their pharma business. But what makes Johnson & Johnson what it is their brand. Like I just said, we know it from a consumer product perspective. They have substantial intellectual property. And really, like we will see with some of these other companies, once your product gets embedded in the healthcare system, you've gone through and worked with the insurance companies for reimbursement codes and whatever it might be, the switching costs are high. And so for a healthcare provider or a healthcare system to really think about, changing from one med device or from one specific product that Johnson & Johnson offers to maybe one of its competitors, there has to be substantial incentive to do that. And so Johnson & Johnson set itself up well, and that's why Morningstar here prescribes them a wide moat with low uncertainty. Again, the consumer product business is stable. They do have drugs out there that are being utilized widely. But when you look up, that all sounds great. But when you look at their fair value here, Morningstar has assigned a fair value of $133 a share based on their analysis of the company. You look at today, and as of yesterday's close, it was trading at $147. So Johnson & Johnson, great company, generating great cash flows with a relatively stable balance sheet. But from Morningstar's perspective, it's expensive right now. And so again, that's why you gotta go through the different layers of, okay, I like the theme of healthcare. Let me look at the specific company. What is this company doing well, and what are its prospects for the future? But then most importantly, what am I paying today for this company? And what is that relative to what I think about when I look at the future cash flows that this company might be able to earn? Is it look attractive? Is it expensive? Whatever it might be. So here in this one case, Morningstar has said that in their opinion, currently, J&J is expensive. One big risk to J&J that everybody's probably heard of in the news right here. J&J's scariest word in recent years, talcum powder. I think most people are aware that there's ongoing litigation related to baby powder and the prevalence of this talcum powder and what that might mean for potential cancer risk and other risks. And it's not just with their product here. There's ongoing litigation with some of their drugs. There's an issue with some of the opioid drugs that they've developed in past years. And so again, for most healthcare companies, litigation is a big risk. J&J lately, obviously the last year or two, has been one of the main headlines of this risk because of this incident with baby powder. So turning away from a big pharma company to who pays for those drugs, when somebody uses them, health insurance company. So here we're looking at United Health Group. It's a narrow moat. United Health Group reported solid first quarter operating results, and despite challenges presented by the COVID-19 crisis, particularly surrounding its own care provider operations, the company maintained its outlook for 2020. In general, United Health's results and outlook bode well for the discounted managed care industry. And what is United Health? And it's not just a health insurance company. Yes, it is the largest private health insurer in the U.S., but it's got many other branches that it's developed or acquired over the years. The brand that many have heard of is Optum. So Optum's got different lines. Optum's got the pharmacy benefits side. It's got the provider of health analytics and other services. So United Health Group is not just a private insurer. They have other branches that diversify this revenue stream, but the insurance side of it is its main operating division. When you look at what Morningstar says about it, the moat is narrow. Again, one reason for that is potential unknowns, and Dennis touched on it. There's a 2020 election, and we know that depending on the outcome, there has been talk, obviously, on the campaign trails of ideas such as Medicare for all. Is that something that's imminent? Probably not, but it is being talked about more and more. And so that is a huge risk to a private insurer, cutting of their really a lot of what their revenue and kind of changing it and shifting it to somebody else. So again, a narrow moat here, a lot of it's regulatory. But again, similar to what we saw on the last page with J&J, fair value here is $304. Well, look where it closed yesterday. Again, fair value based on Morningstar's analysis. It closed yesterday at $304. So pretty much trading right there. And we already talked about the biggest risk to something like United Health or a Cigna or another large healthcare insurance provider. So great cash flows. Cash flows are consistent, but there's risk. And here we'll talk about on this page. United Health also described a number of COVID-19 responses that suggest the immediate risks surrounding the health crisis are probably manageable for the organization and industry as a whole. Their decision to assume all member costs associated with COVID-19, along with its plan to provide $2 billion of advanced payments to care providers, among other actions, suggests that overall medical costs will likely be well under control in 2020. Well, a lot of this, we have the COVID crisis, but what we've also seen in most healthcare systems is a significant drop in admissions, elective surgeries. So, insurers are probably not seeing the typical costs they would see in a given year right now. Second half of the year, depending on how the country reopens and what consumer or the citizens' fear is of going to a hospital, if that is greatly reduced, you might see this change, and they might be a little bit more protective of their cash flows. But for now, they seem to be in good shape. So turning to a subsector, really, of the healthcare industry, on this, we'll look at these are the top 10 holdings in the exchange traded fund, the iShares U.S. Medical Device ETF. Most of these, are familiar when you look at Abbott and Medtronic, Danaher, Stryker, but you're seeing some names that maybe you haven't heard of before if you're not working in this industry. Edwards Life Sciences, something like Intuitive Surgical. So again, these are more medical device companies, but they usually have different arms beyond medical device. And the first company we'll look at here is Abbott on the next page. And Abbott Labs, while in that medical device ETF, we all know Abbott has a lot going on, but it's nutritional business, diagnostics, and Morningstar's comments on this page. Abbott Labs delivered strong first quarter results with strength in its consumer-facing segments, more than offsetting some declines in key medical device categories as more elective procedures have been crowded out by the COVID-19 crisis. And where Abbott has really, shined, I would say, in the last month or two, is in their rapid testing, their development of rapid testing for COVID-19. And so I believe they've developed 2 or 3 tests so far that are being utilized widely. And that's obviously what we need right now as a country, is the ability to rapidly test and determine whether somebody has the virus or not. And so what does Morningstar say about Abbott today? They say that it's got a narrow moat, its current fair value is 75, where as of yesterday's close, it's trading around $92. A headwind to Abbott right now is definitely the decrease in elective procedures, as we talked about previously, and as Morningstar commented on here. They also are going to have to be managing some of their distribution channels and facilities that they've built recently that were a positive in China and India, but now with where we're seeing a concern about supply chain disruption and the abilities for companies to quickly maneuver when a crisis like this hits to get this products to the proper areas of the world that need them, there might be some continuing reconfiguring by Abbott of their distribution channels. Also, something Abbott did recently in the last couple of years was they acquired St. Jude Medical, which focused on cardiac med devices. And as a result of that, they've in a portion of their business, they've definitely increased cyclicality as these products under St. Jude go through clinical trials and different types of reimbursement. So Morningstar's comment here, after incorporating the estimated impact of COVID-19 in our cash flow assumptions, we're modestly lowering our fair value estimate by $3 to $75 per share. Among the medtech companies, we think Narrow Moat Abbott is well positioned to weather the pandemic thanks to its diverse range of products, which we discussed earlier. The second largest med device holding in the ETF is Thermo Fisher Scientific. Morningstar here says the second quarter of 2020 will feel the full brunt of the epidemic, and not surprisingly, the forecast revenue decline range is absurdly large, from flat growth to negative 15%. The upper end of this would imply material uptake of the company's COVID-19 test, which Thermo Fisher can produce at a 5 million per week pace. And given the company's product mix is largely consumables, we anticipate Thermo Fisher will return to normalcy faster than most healthcare companies. And so, again, Morningstar's attributed a narrow moat to Thermo Fisher and has a fair value of $271, while it's currently trading around $342. Similar to the other companies we've talked about here, Thermo Fisher has a very diverse lineup, a number of verticals from instrumentation, reagents, consumables. Again, it's very embedded in the research community at academic institutions and with the government. And so that's where they have very sticky customers there, and they're doing pretty well with some of their contributions to the COVID-19 crisis. But again, they're seeing, like others, decline in areas that COVID-19 is preventing people from using. So some of the diagnostic testing that's outside the realm of COVID-19. And then the big risk for something like a Thermo Fisher is they have been building themselves up through acquisitions. They just made another large one beginning of March, a medical diagnostics company called Qiagen. And the concern is when you're acquiring, if you make a bad acquisition at too high a price, with too much debt, that can really stagnate your company and cause issues for growth. As you have to focus your attention to this problem child, essentially, that you brought into the company. So, their rapid acquisition has built them up to where they are. They can't miss on one of these larger acquisitions. And the last exchange trade fund we'll look at here briefly is the biotech ETF. Again, this is where you begin to see companies that you don't know about until they hit a home run with one of their drugs. So the number one.
Wait a minute, PJ. It seems like that number one is one that I've seen in the headlines recently.
it is, and we will show a chart of it here, and I think 2 slides to discuss, what's been going on with Moderna since everybody knew the name Moderna about 2 weeks ago now. And again, the other companies on here, some of them have probably huge home run drugs that they developed that you may not even know who made them, even if you're taking them. So on this next slide, we'll talk briefly about one of these companies, Regeneron Pharmaceuticals. And so Morningstar here talks about we're maintaining our $421 per share fair value estimate, and they think shares incorporate too large a premium for the value of the firm's COVID-19 pipeline, which is uncertainty tied to efficacy, safety, and ultimate financial benefit to the firm. And so you can see the fair value for 21 currently priced at $578. And so for many of these biotech names, it's all about, can they get their drug through all the various phases of human trials? Can it get approval? Can it get approved by insurance companies for reimbursement? There are lots of hurdles to jump through. And if it gets that far, what's the need for it? How many people need that drug? What's essentially the demand? And from that, you develop every now and then a home run. So with Regeneron specifically, their first quarter was great, driven by a drug called Eylea, which is for ophthalmology surgery. And so again, that has been a home run. It has some competitors, but it's the clear leader right now for that one specific treatment. But again, all these companies have risk. Obviously, at some point, there's ever a problem with your main product. If litigation arises for Eylea or one of their other main drugs, that's an issue. Also, you have to constantly be developing the next big thing, because we all know that with these drugs, there's typically patent timelines that when the patents wear off, depending on the complexity of the drug, you're going to face generic competition, which is going to reduce the price and your revenues from it. And then the other thing, we talked about regulatory risk from the government in terms of reimbursement and from health insurance, but mainly from Medicare in terms of reimbursement amounts. If they don't reimburse enough, that offsets some of what you spend on R&D to develop the drug. And so that's a concern for many of these biotech companies. And then something just specific to Regeneron is a lot of their funding comes from their partner, who is Sanofi, which is a Paris-based large pharma company. And so they have the risk of Sanofi, backing away from that relationship if it needs funding for the next big thing. So here in the next two slides, we're just going to look at year-to-date or I guess 1 year charts for these drug companies. And so this is Moderna. Let's just focus on May. You can see, right prior to May, we were trading around $40 a share. The announcement was made on a Monday about the hope with their initial human trials for a vaccine. There was I believe eight patients, showed positive signs from being administered the vaccine in terms of what the clinicians were looking for the reaction to be. So obviously there's a 2 or 3 day period there where we see that quick rise from Moderna, and then we see a quick fall after that. And what was the fall based upon? Definitely some commentary from the medical community that the data they had seen was not enough to support a strong degree of hope. There's definitely, I think we all have hope for all these companies working on vaccines, but the medical community came out and said they need to see more data to support the hope that Moderna stock price initially showed. Also, Moderna took the opportunity of their high share price to do a stock offering of $1 billion, announce a new stock offering of $1 billion+ to raise capital. And also, unfortunately, it came out from them that some of the C-suite sold around this time their stocks. Now there's debate about when they filed the forms. There's a lot of regulatory requirements for CFO or a CMO or CEO of these companies to sell their stock. You have to go through a lot of hoops. And so Moderna's come out and said it was in place before the announcement of the vaccine. But again, always concerned when something like that comes out, investors see it and you see a negative potential reaction from the market. And we'll contrast that with the next slide, where we're looking at a company called Teladoc Health. And I don't think it's any surprise that when you look at year to date, you see a nice rise for a company that was in a space that has gotten a lot of attention. I think they did over 2 million plus visits in their first quarter, which is well above anything they've done previously. And a reason for this is obviously with people not being able to go and see their doctor in person, especially outpatient, just for routine checkup. It's nice to be able to just get on FaceTime. And unfortunately, before this crisis hit, you couldn't do something like that. Each hospital, each state had regulations around HIPAA or about how you could interact with potential patients. But obviously, COVID-19 has caused the governments to relax a lot of criteria, allowing for over the phone, in-person visits via something like telemedicine. And so we've seen a quick rise, not opining here on whether it has more room to go, but again, Teladoc is in the right spot at the right time for what we've experienced year to date with the COVID-19 crisis. And Dennis, I'll turn it back over to you.
Okay. So in the past, we've talked about the fact that healthcare in the future is going to be a bigger and bigger piece of our budget in the United States and actually around the world, and our budget deficit. So the question is, can healthcare innovation mitigate this risk to future budget deficits? And our guest experts this afternoon certainly have some opinions on that for our live chat. We definitely have a number of evidence that in the future, some of the cost of diagnostics for people who are in the midst of difficult health situations or the most chronically ill or the end of life, some of those may be able to be offset by technology and innovation. The question is how much? And so again, this projection that by 2040, 1 out of every $3 spent in the United States will be spent on healthcare. Some of the folks in our network think that maybe that can be cut down to 1 out of every $4 will be spent on healthcare. That still, I understand, is a lot of money, but again, would be a huge benefit if that can be achieved. Next slide. And so this is an interesting one from one of our leaders in healthcare who wanted to point out that the area, the highest cost population, is focusing research and clinical interventions on the people that have chronic serious illnesses, functional debility, and persistently high costs. And some of that is end of life, but some of that are some of our more vulnerable high risk populations, which again have been disproportionately affected by COVID-19. So we have a very interesting intersection of things that are considered to be one of the bigger issues for our country and the innovation that's going on around those areas. Next slide. So, back to the decision tree that we use at SFG to think about investing in anything, but also the healthcare space. Again, you heard every one of these described by PJ. Is it a compelling value versus risk and future growth prospects? Several of the companies that you saw in this presentation have really solid prospects and they have solid management teams, but there may not be a compelling value right now. Now, again, this is a different thought process. Many of the companies we've discussed are actually large holdings in our firm from clients who have held them for 10 years or 20 years. And they have very low cost basis in many cases for those clients. So the question is, would you sell those companies if they're selling at a significant premium and deal with that cost issue versus buying them new? That is something that we wrestle with every single day because every client has different facts and circumstances around that. Item number 2 is if they do have a compelling value, how much is appropriate in a particular objective and risk level? Traditionally, our thought process has been that aggressive growth folks who have identified more money for explore, maybe they'll do a higher percentage. Folks who are in more of a conservative growth and income mode, it could be a really, really great company or sector and have things happen to it. So we do a little bit more modest allocation. Then we get into what intangibles could be headwinds or tailwinds. Again, the entire written chat on healthcare that you'll be getting probably tomorrow morning will go into this headwinds and tailwinds piece, and there are a lot of them. And then how do we want to invest? Do we want to do active managers or an index? Well, certain types of things in healthcare, you saw the indexes. You may have noticed some of the footnotes that many of those indexes had a third or even up to 47% of their holdings were in the top 5 holdings. That is a highly concentrated stock position. Now, again, maybe a good thing for certain people, maybe not so good for others. And so that's where you get into, when should you concentrate more and when should you diversify more? And then finally, what does this holding replace in the portfolio? Always an interesting dilemma that we have on, again, almost a daily basis is, should we replace it with another, if it's in the healthcare stock area, another stock, or are we leaning into stocks writ large and we want to move out of some other areas? Those of you who've been with us for a while know that we do both on a regular basis, but these are the kinds of things that get into that decision tree. Next slide. And so is healthcare a fat pitch? Nope, sorry, not a fat pitch. Mainly because of that valuation piece that PJ talked about on a number of the different areas. But it is a very solid future investment area. And it's something that, because of all those positive trends, we're going to keep an eye on. And if we get better entry points in corrections, or maybe after COVID-19 frenzy subsides, would not surprise us to see some of these companies settle back down into maybe a more normal trading range. We will certainly be thinking about that in terms of healthcare and whether we want it at normal weight or overweight. And then alternative strategy, and again, this is only suitable for higher net worth clients who can afford to go into illiquid private equity and venture capital. There certainly are a number of interesting opportunities there, and we are regularly evaluating some of those opportunities for the future that again are things that are earlier stage, not liquid, so appropriate for some clients and not for others. Next slide. So we have actually used up most of our time, but there is one question, PJ, that I think is a general one from our audience of, if healthcare isn't a fat pitch, what is?
You got to give me a lot more, parts of that question. Time frame, that's a big piece of it. When you're looking across the spectrum, and we'll show a chart in our written chat that shows, what % recovery have different sectors experienced since the crisis really began. And you'll see, not surprisingly, consumer discretionary, healthcare, technology at the top. I mean, they're that close to their all-time highs as sectors as a whole. What you'll see at the bottom, obviously, what areas have not recovered, and I think you'll see financials, you'll see energy, not surprising. So I'm not going to go out on a limb and say what I think that pitch is, but there might not be one right now, and I think that's a fine answer. There doesn't always have to be one. But from that perspective, the value areas, energy, financials, those areas, again, have been beaten down and have not recovered. And so, if you're a long-term investor, there's potential opportunity there. But there's a lot of risk in those areas. Obviously, we know with the energy side, what happened in March can happen again, hopefully not to that degree. And on the financial side, again, we're still early in terms of working our way through that financial side of this crisis and what that might mean for them. So Dennis, I'm going to punt that question and say that I do not see an obvious fat pitch in any industry right now.
Okay, well, that's a fair answer. And again, I think that there's an assumption that in every crisis there are fat pitches, but you have to combine, again, the concept of a fat pitch is not just something that appears cheap. It has to also have other attributes in there to make the risk relative to it being cheap appropriate to take on. And that's the piece that, again, Warren Buffett has cautioned about many times, but is regularly ignored by investors. All right, well, we are, again, over time, actually, for this part 2 of our Healthcare Week. This afternoon, 4 p.m. Eastern Time, our live chat will be on part 3, and that is direct COVID impact of healthcare. We have several special guests on that one who will provide some pretty interesting commentary. And then we're combining it all together again in our written chat for this special Healthcare Week. With that, we will sign off for PJ and myself and the entire SFG team. We hope that you all have a wonderful weekend and stay safe, stay sane, and stay creative. Take care, everyone. Thank you.